Welcome back. How you doing today? For anybody who has subscribed to my channel, thank you. Big thanks there. For anybody who hasn't, remember to click that subscribe button, hit that bell so you don't miss any of the new content coming out. But today's topic, we are going to discuss moving averages. So first things first, what are moving averages? Second topic, the different types of moving averages. And then we're going to talk about the periods that are mostly used in the industry and using them on multiple time frames. A lot of people get this wrong. There's a few things people don't consider. We're going to look at that. And then finally, which ones I personally use. So what are moving averages? Well, first and foremost, a moving average is a widely used indicator that overlays price. So you see studies at the bottom. Those are usually oscillators, different things like that. But these ones actually go right over top of price on the chart. And you'll see that a little bit later when we show an example. But yeah, so basically a moving average just takes the average price of a certain amount of periods that you determine, however many you want to pick, but it smooths out price is basically what it does. It just reduces that noise. You see price is very choppy. The moving average will just smooth that out and make it easier to see the actual direction that price is moving in. All right. So what are the different types of moving averages? There is more than we're going to discuss today, but the basic ones are going to be your simple moving average, just your SMA or your MA, depending on which platform you're on. So this one here, it just applies an equal weight. So it takes the past, let's say you're using a 20-day period. It'll take the past 20 days, add them up and divide them by 20. So it's just an equal weight to all periods in the observation, right? All right, so the next one that you're going to see quite often is going to be a weighted moving average. And this one here, there's a slight variation to the first one where they take a heavier weight on the more recent prices as it's more relevant to like today's date, right? So they apply a little bit heavier weight to the current prices, and it gives you a slightly different line. We'll get into that a little bit later, but if you want to learn more about these, there's a lot of research you can do on them. We're not going to get too far into it today. But yeah, so the next one you're going to look at is a exponential moving average. This is probably your most popular, and it's very similar to the weighted moving average, except the rate of decrease is different. This one here changes, it exponentially increases as you get closer to today's date. All right, but yeah, like I said, if you want to learn more about these, there's lots of research that you can do, and then you can determine which one you prefer to actually add onto your chart. All right, so the next thing we're going to look at is the difference between these moving averages. So we're going to actually pull up a chart. We're going to pull up this one right here. This is the Aussie dollar on the daily chart. And as you can see, price is pretty smooth here, but then you get this big leg down and then you get some nice swings here, right? So how do we smooth this out and remove a little bit of this noise? Well, the first one we have is going to be your simple moving average. So as you can see, it took price and kind of just smoothed it out. So you didn't see this big drop on it. You did see it decrease, but you could see if price is below it or above it. And that's one of the main things you're going to want to look at when you're using moving averages. All right. So the next one we're going to look at is going to be your weighted moving average. So very similar. However, you will notice a slight difference in just a minute. All right, and then you have your exponential moving average. Again, you probably can't even notice the difference when I have them on separate charts. However, if I pull them up like this, now you see the difference. So as you can see, when price is nice and smooth, the moving averages are almost identical. It's when you see big swings like this here, big movement, that's when they start to show variance between the different moving averages. So that's why I said you need to decide which one you will prefer to use on your chart, and adding it to your system the way you trade, right? So the first one here, the green one, is going to be your simple moving average, equal weight to all of them. And you can tell it moves a little bit slower, right? It's not as steep of a decline, where the weighted moving average here, it actually fell stronger than the exponential. However, the exponential almost seems to hug price a little bit better. So this is the more popular one of the three, right? The exponential moving average, the EMA, is what you'll hear majority of the time. All right. So the most widely used periods, well, these are the numbers that you're going to hear majority of the time. You're going to hear your fast moving average for a 20 period and a 50 period. Then your slow moving averages, you're going to hear a 100 period and a 200 period. However, trading Forex, these are slightly different. These slow moving averages, these are used in stocks a lot because stocks have more trending markets. They're not as volatile as Forex market or even commodities, right? So using one of these, I mean, it could work. I'm not saying it can't. A lot of people still use them. However, they do work better in trending markets. All right. Like you'll hear a 50 period and a 200 period used on the same chart as a crossover, right? You'll hear the golden cross and the death cross. All right. So once the fast crosses below the slow, that's the death cross, and price is supposed to start moving down, right? When it crosses back above, now price should be moving up. All right. So that's just basic. I mean, if you want to get further into the crossover, we could do that in another video. But yeah, these are the ones you're going to see the most of. But I personally don't use these. All right. I use a slight different system for my moving averages. So the next thing we're going to talk about is using moving averages on multiple time frames. Basically, what I want to discuss is the fact that most traders don't actually grasp or even think about this concept that when you're changing time frames, you are actually changing the data set that you're looking at, and you're changing the actual period of the moving average. So you need to consider what data set or how many periods you're actually trying to analyze when you put this on your chart and you change the time frame. If you're dropping down from a daily to an hourly, you're going to be looking at a different moving average, right? A 200-day exponential moving average on an hourly chart is only 200 hours. You're not looking at 200 days anymore. You're actually only looking at 8.33 days. So it's a huge difference when you drop down time frames. So if you wanted to actually use that same 200-day moving average on an hourly chart, let's say, you would need to set that period for 4,800 because that's how many hours are in 200 days. All right. So a lot of people don't grasp this concept that if you wanted to look at the same moving average on a different time frame, you need to change that period as well. All right. All right. So now we're going to look at what these actually look like on a chart. So the first one we're going to pull up is this here. This is a 200 period on a daily chart. So we're going to not consider them as 200-day moving average, even though this one is because we are on a daily chart. But we're going to start talking about moving averages as a 200 period moving average because that's actually what it is. All right, so now we're going to pull up this chart here, which is the hourly chart. And as you can see, it's still the same 200 period. However, it's only 200 hours of data that you're looking at. You're not looking at 200 days anymore. So you can see the moving average is a lot different. It's a lot tighter to price than this one. This one's a lot smoother, whereas this one has choppy movements, kind of. It does smooth out price. However, you're looking at a different data set. All right. So if we wanted to look at, this is still the 200 period on a daily chart, but if we wanted to look at that same data set on an hourly chart, we would have to pull up a 4,800 period as we just discussed. And as you can see, it is the same on both charts, right? We have our high here and our high here, right? So it's the same exact moving average. So if you were trading off an hourly chart and you wanted to know where that 200-day moving average was, it would be up here. So if price made it to that point and you're not looking at your daily chart, you would still know where that moving average is, right? So that's something you need to consider if you're going to be using moving averages. Which data set you're actually trying to analyze. All right. So now we're going to get into what I personally use. So I consider these factors when I'm trading, and I don't really use just a 200-day. Like, I don't know who really considered coming up with this number, because what is 200 days? What does that actually represent? So I use actual numbers that make sense to me anyway. I don't know if they make sense to anybody else, but they make sense to me, right? I personally use an exponential moving average. It does hug price a lot nicer, and you get a lot more touches, and it doesn't really go through price as much. You get a lot less false signals, to be honest, in my opinion. All right. But for 1 hour timeframes and below, I use 1 day of data. All right. And I'm going to show you how I calculate these in just a minute. But yeah, just remember I use 1 day of data for anything on a 1 hour time frame or below. And then I use 1 week's data on a 4 hour chart and an 8 hour chart. 1 month's data on a daily chart, and 1 year of data on a weekly and a monthly chart. So as you can see, I'm not just grabbing random numbers like a 200-day moving average, because that means absolutely nothing to me personally. I'm looking at from the time price opened today to the end of the day, what happened, right? When it opened this week and closed this week, what happened? The past month, what happened? And then finally, in the past year. And these are all rolling averages, right? So as soon as you move one more day, you're dropping the last one and adding on the newest data set, the newest observation, right? So these are all rolling moving averages. And let's just say you do have a 20 period. If you add on a new day, you now technically have 21 days. So you're going to be dropping that first one and continuously rolling that out, right? All right, so now we're going to look into how I actually calculate these, right? So for my 1 day data on a 5-minute chart, I use a 288 period, which is 24 times 12, right? So there's 12 5 minutes per hour times 24 gives me 1 full day of data, right? On a 15-minute chart, I use a 96 period, which is 4 times 24. Every hour, you have 4 15 minutes times 24 hours, gives you a full day of data. And then the easiest one, the hourly chart, 1 times 24, you got your 24 period moving average. All right, so this gives you all 1 day of data. So next we're going to look at the 1 week's data. So first thing, we're going to look at a 4-hour chart, which I use a 30 period moving average because every day you have 6 4-hour periods, right? And then you want to multiply that by 5, which gives you a full week of data. And same thing here, except twice as much. So you have 8 hours. You have 3 of those a day and 5 days a week. So 1 week's data. Yeah, that's what we got. Next one, we got 1 month of data. This is going to be my daily chart. This one's a little bit more complicated to do the math, but it's not overly complicated. So first thing, you have 52 weeks in a year times 2. So this is going to give you how many weekends, like how many days are we actually closed, right? And then how many bank holidays do we have? So this is going to determine, these two numbers here, how many days in the year are markets actually closed for. And then we have our full year, 365 days. So we take that minus 104 plus 8, which gives us our 21 period. So this is our average month, right, of how many days the market is actually open for. All right. And then here we have 1 year of data. This is going to be our weekly chart. 1 times 52 is 52 weeks a year. All right. And then we have a monthly chart, which is 12 times 1, 12 months a year. And simple, just like that. All right. So the next thing we're going to look at is what these actually look like on a chart. So these are the ones I personally use. And this is what they look like. As you can see, we got a 5-minute chart here, a 15-minute chart here, hourly chart here. These are all going to be 1-day data, right? As we just discussed. And you could probably already tell that, yeah, price is different. Price looks quite different between these. However, the moving average is identical. There is no variation between these moving averages because I personally adjusted for these, right? When I set the amount of periods that I'm looking at, because I want to know in the past day, the past 24 hours, and this is a rolling number as we discussed, is price above or below the moving average? All right, so yeah, that's our 1-day data. All right, so next one's going to be our weekly data, which is going to be on our 4-hour chart and our 8-hour chart. I don't personally have the 8-hour chart up right now, but that's fine. We're just going to look at the 4-hour chart. And as you can see, currently price is below the weekly average. All right, so this is a rolling number and we are currently below it. So the likelihood of it reverting back to this mean is fairly high. All right. And next thing we're going to look at is the daily chart. So this is going to be our 1 month's data. And this one, as you can see, hugged price very nicely. This is our 21 period on a daily chart. And it hugged price very nicely. We had multiple touches and you could see clearly anytime it touched it, it fell, touched it, fell, touched it, fell, touched it, fell. Finally, it broke through, came back, retested it, here, retested it. And these were screenshotted yesterday. If you were to look at price today, you would see price did actually move up. I think it was up almost 1% today. So yeah, it did bounce again off that moving average. All right. So currently we are above the 1 month moving average. All right. Now here, this is going to be our weekly chart. So as you can see, for a year's worth of data, we are currently below the average. So the average price for a rolling 52-week period, we are below that moving average. All right. So these are the ones that I personally like to use. It just makes more sense to me than just grabbing some random number. I don't know who decided a 20 period, 50 period, 100 period, 200 period. I guess they're just easy numbers to use. But the main thing I want you to understand here is that when you're changing time frames, like you can use whatever period you want to use. These are just what I like to use because it makes more sense. But when you're changing time frames, the main thing I want you to know is that you are changing the data set that you're using. All right. So just account for that and figure out the numbers that you really want to look at or the period that you really want to look at and adjust accordingly. All right. We're just going to quickly go over what we talked about today. There are various different types of moving averages: simple moving average, weighted moving average, exponential moving average. There's a Hull moving average. There's a least squared. There's an Arno. There's a whole bunch of different moving averages. We're not going to get into all those. Do your research, play with them a little bit, back test them, see which one works best for you, and yeah, go from there. All right. And like I said, grasp the concept that periods are based on periods. They're not based on days. I see a lot of people talking about, oh, I'm using a 200-day moving average, but they're on an hourly chart. I'm sorry, but you're not using a 200-day. You're using a 200-hour because they are periods. All right. So just grasp that concept when you throw these on a chart. All right. Like I said, changing the time frame changes the data set you're using. All right. Find out what charts you will be trading on. Are you going to be using a daily chart, a 4-hour chart, a 1-hour chart, 15-minute chart? Whatever chart you want to use, adjust the moving average accordingly to what you're trading. So that's it for this video. Hope you enjoyed it. Hope you learned something that you didn't know before. And hopefully adjusting these little numbers here when using moving averages will help you in your trading and help you become profitable. All right. So if you haven't subscribed yet to this channel, I'll be throwing out a lot more videos, a lot more concepts that I've learned over the years. So make sure you hit that subscribe button, hit that bell for notifications on my next videos. And if you like this video, hit that thumbs up. And yeah, I'll see you in the next one. Take care. Have a good day.